September 35 calls. Oh, that was for the short-term portfolio. We made an aggressive move on Schlumberger for the short-term portfolio. In the long-term portfolio, we did these spreads. We sold 10 of the Schlumberger 35 puts. Let's get Schlumberger up on the screen. I think you can, see how it stays on top. That's nice. SLB. And get out of the way a little bit. All right, so this was just yesterday, actually. Should have asked it what day it was. So these guys were yesterday. And so for Schlumberger, if you look at the hourlies, you'll see what we did. So as it was down here yesterday morning, well, it was way down here yesterday morning, we jumped on it and took advantage first thing. It was in the Morning Post, so was USO. And we took advantage of this dip because we thought it was a bit overdone. Although it's gone up, it kind of came down again. So hopefully it's an overdone drop and they start picking back up. And then the other one we did was Pfizer, and that was at the beginning of the week. And that was the top trade alert. And look at this is hourly, so I forget when we did it, but I think it was down. I think it was like around here on Monday. Yeah, it was, and that's come up nicely since then. Obviously, it's a long-term trade. It's not like we expect it to go up in a day, but if it does, that's nice, right? It's a good start. And notice on this spread, we sold the 170 puts because we think 170 is a good price. Don't forget, this is 18 months out. We bought the 160, 200. Here's 160, and here's our goal is up here at 200. Well, this is an hourly chart. If you look on the weekly chart, you can see it's pretty reasonable. So we have the 160, 200 bull call spread, and we have an imbalanced amount. So we bought 15 longs and 10 shorts. So that means that selling 5 of the September 180s can't hurt us. But we sold those calls, didn't say how much, but we made good money selling the calls, and we sold the September 165 puts. And so we're creating a huge amount of income off of that trade, and that's a nice way to play it. All right, so now, where is this thing? Oh, here they are, list. So now I'm going to go back a week. Hopefully. Great. It's a little slow. I don't know if that's because Chrome's running or if it's just being slow. All right. So now we have the next one. I say, I have now loaded, loaded the prior week. What portfolio trade ideas did we discuss then? I mean, this is a hell of an analyst tool. I mean, for anybody who's got a web-based business, to be able to go through your site like this and double check things and pick out facts and so on and so forth, it's freaking amazing. So in the short-term portfolio, we sold some Apple puts. That was a good deal so far. We sold the 180 puts. They were well out of the money. In SQQQ, that's a spread that we took for the short-term portfolio. So that's our primary hedge at the moment. And in the long-term portfolio, the first trade we added to the new long-term portfolio was Pinterest. And we sold the September 36 calls, and we sold September 33 puts, and there was a long play. He doesn't have it for whatever reason. There's also a bull call spread as far as I know. But that's very cool. What were the top 3 prescient calls made by Phil and or the AIs? I mean, this is just amazing stuff. And this is an untrained Gemini session. It's so good at parsing data. Okay. Top 3 pressing calls. Cautious stance on the market. Which way Wednesday? Phil stated we were a bit bearish and advised caution. Despite the market optimism, he pointed to a perfect storm of tariff-free positions in the Q2 earnings season, creating high risk. This call was validated by the market's performance. We saw a drop in May retail sales and a sell-off where the S&P 500 fell and the VIX volatility spiked. That was great, except it came right back. The Fed's policy purgatory. Warren produced a comprehensive analysis of the Fed meeting, accurately predicting the Fed would hold steady with no clear future direction, a situation it aptly named policy purgatory. The report correctly anticipated the Powell's caution, signaled September cuts increasingly unlikely, and that the dovish market expectations would unwind, which is precisely what happened at the end of the press conference. Impact of geopolitical tensions. The AI systems repeatedly highlighted the Israel-Iran conflict as a driver of a risk-off tone in the market. This was confirmed by the market's behavior on Tuesday, where the escalating tensions led to a flight to safety, with the S&P declining. But again, that was a one-day event. What were the worst calls that were made? What did we get wrong? Got to be fair and balanced, right? If we got things wrong, right, we must have gotten them wrong. So on every single tab, it's what it is. You have to be careful though. It's going to make, see this blue line on the outside? That's your active tab that Gemini is searching. But if you're in, but whatever tab you're in, you just have to click the little Gemini symbol, and it pops up and does this, and then you can start asking it questions based on whatever you're looking at, which includes, of course, summarizing an article, or summarizing any information. So whatever you're looking at, it's going to be able to read it and deal with it, and that's freaking amazing. So this is a hell of a productivity tool that everybody, you should at least play with it and get familiar with it. You never know when it'll come in handy. I'm telling you, if you play with it, I guarantee within a week something will come up where you'll be like, oh, I'm glad I know how to do that. Oh dear, I really stumped them with this one. Oh no, I didn't. There it is. Okay. Based on the portfolio reviews, Synchrony Financial, the Money Talk review in this portfolio described having terrible losses so far, although the long-term outlook for the trade remains positive with a 161% upside. The current performance made it a significant short-term loser. Significant? Really? Did it get worse? Oh no. Let's see. No, it's coming back nicely. Give me a break. Boy, it's just no pleasing some robots. Look at that. That's fantastic, especially in the last week. And when did we get it? We got it in November around Thanksgiving. So it's coming right. It's right now. It's back to where we started. We picked it up in Thanksgiving. And again, this is why I don't like to buy things at the top of a channel, because look what happened. But we picked up in Thanksgiving. We think it has plenty of room to climb. In fact, look at the PE of this thing. It's still 7.5 after this whole bounce back run. It's still trading 7.5 times forward. Lockheed Martin. This position in the money talk portfolio was explicitly singled out for its poor performance. We took a massive hit on LMT as LMT fell off a cliff. Oh, well, that should be back a bit. What happened here? LMT, hopefully coming back. Nope. Okay. Boy, even the war, it was a very short war, unfortunately, but even like the war stuff. But you know what is in Lockheed Martin's favor is Trump is forcing NATO, and he's been trying to do this since his last term. So it's like 8 years of this now for NATO. But he's finally got NATO's arms twisted enough where well, he's doing it by threatening tariffs and also by withdrawing U.S. support in Europe, especially from Ukraine. So NATO is obligated to step up and do something. But the thing is, what happens? NATO ends up buying U.S. weapons. So this whole thing is a scam for the defense industry to sell more weapons to Europe. That's basically what this is about. They can't buy it from Russia and China, right? So where are they going to buy the weapons from? From the top weapon seller in the world. So that will benefit Lockheed Martin in the longer run. Pfizer, while expressing long-term confidence of Pfizer in the money talk portfolio, acknowledges the current underperformance, noting they aren't loving us so far and it only looks like a loss because it is at the moment. Like the others, and considered a good setup for them. Oh boy, I'm funny, aren't I? PFE. Yeah, not much improvement there. Oh, really, really good one to get into at this price, man. $24 for Pfizer. And again, look at the frickin' forward PE. It's 7.86. What do you want? It's frickin' Pfizer. Their dividend is 7%. So yeah, we don't have Pfizer in the long-term portfolio. What's wrong with this? Okay, so let's bring out the mathematical calculator. Win USB display. What on earth is that? What is this? Weird. Won't you go away? I don't know what this is. I don't have a USB display. Can we make that go away? I'm very confused. All right, so Pfizer. So if we go to Pfizer, oh, I was naming my calculator. That's what's not there. La da da, there it is. Okay, Pfizer. So Pfizer pays $1.70 dividend. And that means you can buy, okay, so do I have somewhere I can put notes? I know where I can put notes. PhilStockWorld. Is this today? This is not today. Am I not logged in? I should be logged in. Okay. Oh, you know what? PhilStockWorld again. PhilStockWorld. And PhilStockWorld. Let's find our portfolio review. So I make sure we don't already have Pfizer. Portfolio review was here. We don't have many stocks, so it's not like, and we just reviewed all the new ones we added. There's the Money Talk portfolio. Do we not have Pfizer there? That'd be a good place to put Pfizer also. No Pfizer there. We have Lockheed Martin. We do have Pfizer in the Money Talk portfolio. I will be on the Money Talk show. No, not next week. After July 7th, the 9th. Pfizer. But for the long-term portfolio, I think we should have a dividend play in there so we make sure people know how to do them. What is this? The $700 a month portfolio. That doesn't have Pfizer, but it's also might not be affordable for it. I have to consider that one. There's a short-term portfolio. And here's the long-term portfolio. No Pfizer. Oh, we do have Whirlpool. Somebody made an offer on Whirlpool. Now then I'm gonna forget about Pfizer. WHR. Why is Whirlpool not up? Company will benefit from closing Whirlpool spin and load. Oh, maybe it was just a rumor. Interesting. I heard, well, maybe I shouldn't say it. All right, forget I said that. Forget I said anything about Whirlpool getting an offer, because I shouldn't know that. Okay, back to Pfizer. But meanwhile, yeah, it puts me in a funny position. So meanwhile, we have Whirlpool, and we sold the September 9250 calls. So if, for example, somebody was to offer to buy Whirlpool, well, we sold them for $7, so it's $99.50 is what we sold them for technically. But if Whirlpool were theoretically to get an offer, it would certainly be for more than $100. It would be more like $115 to $120, and that would not be good for the short extra calls that we have. But then the question is how good. We have 25 longs, we have 20 short calls. We have the short puts, which would expire worthless, and we have these short puts will expire worthless. If they get sold for, let's say, 110, 115, or let's say 112.50, then these would be $20. We'd be down 13 times 10 is $13,000 on these. So maybe we should buy them back. Maybe we should buy them back during this cycle. Just a funny feeling I have. All right. Just, theoretically, if there were to be something, then we'd be better off buying them back, is what I'm saying. So where are we? Otherwise, What, wait, what were they doing? Oh, yeah, right. Okay. So here we are here. And now what I was going to do is construct the trade right here and now. Okay, so. Webinar trade. So Pfizer. So we want to play this to the 150 dividend. So okay, so thing number one is we are going to buy 1,000 shares of. So how are you? By 1,000. Oh, I see what I PFE at how much is Pfizer? 24.25. 24.25. All right, so step one, buy the stock, right? Not going to get the dividend if you don't own the stock. $24,250. Sell 10 PFE. Now we're going to sell the position we have. So we have 24, so at $25, it's $230. All right, so we're going to sell the $25 calls, 2027, $25 calls for $230, $2,300. Yeah, let's say 4. Okay. And then we're going to sell, oh, certainly, we'll take that money. Holy crap. 360. All right, well, that's a good price, man. So we're going to sell 10 PFE 2027 $25 puts for, what did I say, 360? $3,600. Okay. A simple little trade. So we're buying it for 25. We're selling, well, not 25, 24, 25. We're selling the $25 puts for whatever, and we're selling the $25, I'm sorry, the $25 puts for 360. We're selling $25 calls for 230. And so what are the mechanics of that? Dun, 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 dun. Oh, come on. Stupid thing. Here we go. Now you can go back there where you belong. What did I do? Yeah, I was right. All right, so very simple. We're just doing this. So what is that? That's net 24,250 minus 2,300 minus 3,600 is net 18, comma, don't know, it disappeared. 350 is net 18,350, and we get called away at 25,000 for a potential 25,000 potential 6,650 gain. So it's 6650 divided by 18,350 is 36 point whatever percent. 36 point, I'm not used to these things disappearing. I have much bigger screen space at home. Oh, I got the 2 right. Okay, so 36.2% plus, oops, upside potential plus, because we are not French, Yahoo. Any Yahoo tabs here? You're not Yahoo. Damn it. Oh, you know what happens? You open Yahoo and all of a sudden the freaking browser switches to Yahoo. They suck. Oh, Pfizer, right? P-F. Historical data. So I check the dividends. I don't care what the dividend says. I want to see what they're actually paying out. There you go. 43. Whoop. 43. 42. 42. Okay, I'm gonna call it 42. Okay, plus 6x042, 420 in dividends. Wait, why did I say 6x? Good question. What gave me this impression? Oh, that's right. Okay, they paid May and they obviously paid January. So yeah, there are 6 times. Like muscle memory, right? It's like I get it right even when I'm not thinking of it. So that's 6650 plus 2550. How can, sounds wrong. 420 times 6, 2520. Aha. So 2520 plus 6650 is 9170. That sounds good. 9170. Basically half, right? So that's a really simple dividend play. And there's not much downside for us because we sure don't mind owning Pfizer. You know, there's no problem for us to own 2,000 shares of Pfizer because in ordinary margin, we're going to get a 50% credit. So if we have to stock and we have 2,000 shares of stock, the margin for 2,000 shares is only going to be $2,400. I mean, $24,000. And we're going to get double the dividends. So, and we'll be able to sell twice as many calls. So we'll be able to pick up quite a lot of money against, in fact, what are we picking up now? We're picking up $9,000 in 18 months, right? So if we have 2,000 shares, we would do the same thing basically. And then we would have $18,000 coming in, using up $24,000 in margin. Currently, we're selling 10 of these $25 puts. Sell single for $360, and see the net buying power effect is only $4,800 because we're collecting 36, and then the rest would be margin, but the cash comes out of the margin. So we're only putting out $4,800 in margin to make that trade. So that's a very, very good use of our buying power, right? So we're putting out $4,800 in margin in order to get $9,000. So it doesn't look great, you know, when you look at it on paper, you say, oh, it's only a 50% return, but it's really a 200% return on our margin, and our worst case scenario is fantastic. So hang on, let me print this. So that's an official trade. And now let's talk about what happens next on a trade like this, right? So, you know, you can't get fixated on ordinary numbers. You just have to work through the math to figure out how good a trade is. So from June 2025 through Jan 2027, we are laying out 18,350, 18350 in cash, and what do we say in margin? I forgot, 48. Yeah, 48.78. So let's say 4,900 in margin. All right, and so we collect well, we collect 2,520 in dividends, and whatever gains over our net cost, and our net cost is 18,350 over 1835, over 18.35. So anything over 1835 is going to be a profit on top of the dividends, and this, of course, assuming that we collect the dividends, right? So, you know, let's say for argument's sake we hit our 25, right? So then January 2027 to January 2029, what happens then? We collect 8 times 420. 8 times 420 is 3,360. Now, what did we just do though? We just lowered it by 336. So it's now 18.35 is our basis. minus now, nope, sorry, I did that wrong. So our net, I should put that down here, net. So our net is 18,350 minus, right? It's 18,18350 minus 2520 in dividends. So it's 15,830. So our net is 15,830. Now we collect 3,360 in dividends. Net 18. Okay. Sell 10. Jan 2029. No, you see January. Sell 10 2029. 25. I'm just going to leave it flat. Just pretend, because you got to accept some normalcy in this thing. So sell 10 2029. 25 calls for the same, 230, $25 puts for 360, and that's another $5,900, $5,900, okay? So here, it's worked into the price. The net is worked in here, but here, we've already got the net. It's down at 15,830. Now we're selling another $5,900 worth of puts and calls. And we're going to collect the dividends, right? So now, in January 2029, we are at net, January 2029-2031. Okay, now our net is what? Our net was 15830 minus $5,900 worth of puts and calls minus 3360 in dividends. So our net is now 6570. 6570. And what do we do? Sell. We're just gonna copy that, Control C. And of course the prices will change, the strikes will change, whatever, but the concept is there. So it's 2031, $25 calls for 230, and the $25 puts for that. And we collect all right, so don't forget, we dropped our gain here. We're still getting called away at $25. That's a $19 gain here. Whatever gains over is now over $6.57. But we're still selling those $25 calls for a target or whatever Pfizer is at, basically. All right. So now it is January 2031. And what do we have? We are at net we were at 6,570 minus 5,900 minus 3,360. So 2,690. So basically, 6 years from now, okay, we start with 1,830 in cash and 4,900 in margin. And in 3 cycles on this trade, what happens? We have a net 2,690 credit. So now we put 2,690 in our pocket in 2031. And so in January 2031, we've got 2,690 credit in our pocket. We still have 1,000 shares of Pfizer that are worth $25,000. That's pure profit. All the rest of the money is already back in our pockets by that time. and then we could start the cycle again. And if we start the cycle again, then the first 1,000 shares are just paying out profits. They're paying out how much profit? They're paying out $33.60 in dividends, and they're paying $5,900 in the short puts and calls. So figure, 9,000 something dollars. I'm sorry, it's more. It's it's about $9,000. So $9,000 against no cash outlay. Plus, we're getting another $9,000 from the second set of Pfizer puts and calls we sell. So now we're collecting $18,000 per cycle. $18,000 is the entire amount of a cycle. So what happens in January? So we have a net credit, right? So now in January of 2031, okay, we have a net credits, buy 1,000 more shares and begin new cycle. So now we're collecting 18,000. Everything is double. So now we're collecting, we were collecting 9, right? 5,900 plus the dividends. So now instead of that, instead of collecting 9,000, we're collecting 18,000 per cycle. So that means that January 2033, all right, we are effectively at net zero. We got all our money back already. Buy 1,000 more shares. And now we're collecting what? Collect $27,000. It's not doubling, it's 50% more, right? But that still pays for the entire 18,000 we had now. So January 2033, net $9,000 credit, buy 1,000 more shares. And what does that mean? That means we had a $9,000 credit. So now we're at net 9,000. And what are we doing now? Now we're selling 3 times 9,000. Now we're selling, not 3. This is 3. This brings us up to 3. So buy 1,000 more shares here is 3,000 total. And here we're up to 4,000 shares. We're collecting $36,000. Collect $36,000. Okay, and then we get to January 2035. This is 10 years from now. Okay. So in January 2035, we were net 9,000 in, buying the fourth set to get to 4,000. Now we collected 36,000. That pays off that 9,000, and collect 36,000. Still $25,000 credit or balance, positive balance, right? And it's 18,000 to buy another set. So we have 4 sets, 4,000 shares. Okay, so we can just keep going like that, but you understand. So the point is, if you take 18,000 now, we're going to collect 36,000. You're going to collect 2 times, or one. I'm sorry, you're going to collect 100% every year, right? This is a 2-year cycle. So by 2035, or actually by 202, by 2035, in 10 years, if you take 18,000 now, you will be collecting $18,000 a year from 2035 on. So all you have to do is take a year's salary right now, put it into this program, and starting in 10 years, you will get a year's salary as your bonus every 10 years, plus any appreciation in Pfizer, and if they increase the dividends and so on and so forth, and you could sell some short-term puts and calls and do some other fun things. But the bottom line is just following a very conservative strategy like that, you can be in amazing shape. All right. And I'm gonna make a note, just notes, but I'll have Warren explain it better. So there you go. If you want to retire in 10 years and you want to make sure you're getting your same salary you're getting now, there you go. Very, very simple. And Pfizer is not a particularly risky stock. It's at a very low place in the channel. It's currently trading at less than 8 times earnings. And it's been around for 100 years, and it'll probably be around for another 100 years. So it'll probably last through your retirement. That's the weekly chart, by the way. This is the monthly chart. So we're at like the 2000, we're not too far off the 2000 crash lows. Does it go to 1999? Yeah, even I'm sorry, the 2008 crash lows. Even in 1999, it was better than this. It was, I mean, this is just stupid. So and the big reason is Pfizer's not really participating in the weight loss thing, which is the big thing that everybody's putting money into now. But they got plenty of drugs. They're a great company. They make tons of money. They're a little money machine. And they don't have to pay that dividend. That dividend is crazy. But this is how you build wealth. You can do it sensibly. The very, very simple way to play Pfizer. We're not leveraging too much. We're not doing anything crazy. We're selling calls at the money, basically. Short call. We're selling short calls at the money, and we're promising to double down in 2 years. That's what we're doing. But that's our plan. That's what we want to do. We want to accumulate 5,000 total shares of Pfizer over the next 10 years. That is our plan, is to get to 5,000 shares. And how am I going to get to 5,000 shares? How am I going to get to 100,000? Oh, I'm sorry, I forgot to mention that. You also own 5,000 shares that are worth more than $100,000. In addition to the fact that you're getting paid your salary every single year on the dividends and the options you sell, you are also holding 5,000 shares of Pfizer, which are worth $100,000. That's like the phantom gain at the end of the thing. And those are long-term capital gains. So not only will you be set collecting your salary for the rest of your life, but when you're done, you just give the shares to your children and they'll be collecting your salary for the rest of their lives. And this is how people get rich. All right, so that's something really, really important thing to impart to you. That's a really great way to go. So that's why I want to put it in the long-term portfolio. It's not so much because we want to make $10,000. It's a matter of saying, here, I can teach you guys how to do this. I can show you year after year after year. This is how it works. Yeah, see if I can get Warren to do a good job. Maybe we can do something like that in the well, we're already doing it in the Money Talk portfolio, actually. But holy cow, I mean, it works so well and such a major safe stock. And forget the fact that it went to 60. I wouldn't be buying it at 60. I'm not paying 25 times earnings for Pfizer. But anytime it's around 30, we buy it, and it's around 30 a lot. I just don't buy it when it goes up here. I don't care if there's a frenzy. This was whatchamacallit anyway, this is COVID. So, there was a frenzy in the COVID shot and this and that. But you know what it is? This company is always in a position to take advantage of something like that. There are not many companies in the world that have the manufacturing and distribution and testing network and the labs to synthesize things and to make enough doses for the entire population of America. Who can do this? really only Pfizer and Merck, a couple of, I mean, as far as the total quantities that they made. I mean, the smaller farmers can do stuff too, but the total job to put, to take the government's money and rapidly deploy billions and billions of dollars through their network in a successful manner. And not only that, who's the government going to trust? Who are they going to give the money to? Are they going to give it to Bristol Myers because Bristol Myers says, we think we could do that? And they're going to be like, no, no, no. We know Pfizer can do it. We don't know you can do it. You can say you can do it, but can you? That's how it works. If when the fate of the country is on the line, these are the guys you're going to turn to. You can not like them for whatever reasons, but these are going to be your go-to guys. And they will come out with the next Viagra or the next weight loss thing or whatever fad comes up next. Anti-senility, that would be a good one too. All kinds of ways that you can make money with this stock. See if we have any questions. Daniel says, any thoughts on Meta and eBay partnering up to allow eBay listings in Facebook Marketplace? I got to tell you, I don't even know what the Facebook Marketplace is. Oh, yes, I do. I'm sorry, I do. I've seen things in the Facebook Marketplace. That is an ugly place. But okay, so let's move on from that. The partnership began in January 2025, and it's in its early phase. What is that? It's weird. It seems like it's two questions, but it's not. It's on a trial run with early listings available in the USA, Germany, and France. Any thoughts on it being a viable trade? I would say, obviously, it's good for Facebook. I don't know how good it is for eBay because they've got their own marketplace, so now they're going to pay Facebook a commission, right? Basically. So let's see. Is this Bodie? Yeah. Wait a minute. Which one is this? Bodie. Okay, thank you. So let's put your question into the machine and see what the machine says. Dun, 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 dun. And all I'm doing is taking a question, putting it in Bodie. He's going to check it out for us. But anyway, so those are my initial thoughts without doing any particular research. But it just seems to me that eBay is just giving Facebook a piece of the action for putting it on their thing. So it's beneficial to Facebook, but I don't see how it really does more for eBay. So Meta is testing a feature where users can browse eBay listings directly on the Facebook Marketplace, but transactions are final. Oh, it goes the other way. Well, that's good for eBay then, right? Obviously. So basically, eBay's getting more exposure, and obviously then they'll pay a referral fee to Facebook, but that's fine. The trial's available only in the US, Germany, and France. This is partially response to EU antitrust pressure. Meta was fined a bunch of money for being bad people. No details for further rollout, but Meta says it intends to explore. eBay stock surged 13% on the announcement in January, reflecting investor optimism. Meta's stock declined slightly on the news due to regulatory overhang, blah, blah, blah. That's not on the news then. Strategic rationale for eBay. Gains exposure to Facebook's vast audience, especially younger users and those interested in sustainable resale goods. Potential to increase traffic and conversion on eBay listings. Right, it's all good for eBay. Why not? eBay has 300 million users and Meta has 3 billion users. So therefore, you have a much larger exposure to potential customers. And also, like I said, I've seen Facebook Marketplace. It has never been very impressive with the amount of goods it has. So for Meta, they want to gain traction of goods. That's the thing. There's not a lot of stuff in the Facebook Marketplace. eBay, on the other hand, has tons of stuff and needs buyers. So Facebook needs stuff and eBay needs buyers. So that's a pretty good combination. Enhances marketplace's value proposition without handling more transactions. That also is good for them. Viability as a trade. eBay gets new high traffic channel potential for incremental sales, especially sellers in saturated markets. Facebook gets more inventory. I just said that. if the trial, but that's the point though, isn't it? Right? It's like I have done my best to impart my knowledge to Bodhi to make him as good a researcher as possible. So therefore, he should be giving answers that I give. Although in theory he should be giving better answers than I give because he's got to do more research. But even if well, it's possible that I didn't miss anything. That's also possible. It's possible that if you do more research, there's no more to give you because I already figured it out. So more inventory if the trial succeeds, the wider rollout could be significant. Con, still a trial. There's no guarantee of a permanent expansion. Transactions still close on eBay, so there's nothing wrong with that. Competition remains fierce for both platforms. Intense competition, classified resale market, logistics and compliance. Sellers must navigate international shipping, capital, blah, blah, blah. So what? That's just life. Other considerations. If you're a seller, this could be a low-risk way to test new channels, especially if you've already established on eBay and they meet the requirements for international sales. That's very true. If you're an investor, the initial pop in eBay stock may have priced in much of the near-term optimism without a successful expansion. So it'll be interesting to check out eBay's conference call to see what they say about it. As a trade, the eBay Facebook marketplace integration is cautiously promising opportunity for eBay, especially if the trial expands, blah, blah, blah. Blah, 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 blah. Conclusion worth tracking closely. Okay, so then after that, I'm going to go to eBay and see how impactful this can be. So we go eBay. And all I ever care about, I mean, not all, but my first thing I care about that they have a $34 billion market cap. I look at the PE, but I mostly care about this number here, 34 billion. How much do they make? They make $2.5 billion. So I don't care what that says. I take 34 divided by 2.5 is 13.6. That was what it said. So they have a 13.6 PE. That's pretty reasonable. How bad is their debt? They're only a couple of $1 billion in debt. But it went from negative. They had no debt and a credit, and they bumped up to 1.5 billion. I would want to dig into that and see why their debt increased by $2.7 billion between 2023 and 2024. What's the trajectory? Is it now? It did here too, though. It went from no, it didn't. Sorry, I'm wrong. It's been going down there. No, I'm sorry. Their debt went down significantly, right? From 408 to 1.7, then 1.4, and then back up. Now, maybe that's just the way they do it. Maybe that's just their investing cycle. It's not necessarily bad, but I want to find out why they went to $2.7 billion in debt. Was it a plan? Did they have something they wanted to do? Did they buy somebody? That's what you want to find out. So, and in fact, I can say that to Bodhi. I see they took on a lot of debt from 2023 to 2024. What's up with that? All right, see, it's a very complex programming language you have to use with your AIs. Of course, in truth, he's used to me, so he knows what I mean when I say something like that. But you can get him used to you too if you use him enough. So we have that to deal with, and then I want to go over to FinViz. And the thing I like about FinViz now they're not low in the channel. Oh, that's a monthly channel too. So they're not low in the channel, but on the other hand, it's a monthly channel. So it means way back here, they made enough money for people to like them at 75. But on a weekly basis, they're high in the channel. So that means they usually have a pretty low valuation. And you see this, the earnings per share have been erratic. Sales, though, are generally trending up. Shares outstanding are coming way down. Wow. Wowee. Is that what I bet is he going to tell me that they bought a bunch of shares back and that's where the debt came from? I don't know that I like that, though. What? Total debt, net debt. Robust cash. eBay used. They used its cash for share repurchases and dividends while still reducing debt. No large acquisition. See, he's not afraid to tell me I'm wrong. eBay's debt load has actually decreased. Okay. But in Stockopedia, I see this. La-da-da. See all the work I have to do before I tell you guys something? No, I don't want to see all that. Oh, highlights everything. Stop it. See, this is how much work we have to do just to answer your question. You know, sometimes they're easy and sometimes they're not. I wonder, in Seeking Alpha, can I now put in eBay? Because they have this new presentation of the news. No, I can't. Damn it. News. Okay. Wait. Show full stories, right? So if I put in eBay, is it still going to let me show full stories? No, it is not. See? It takes me to eBay. It doesn't show me stories about eBay. News. Oh, that's a shame. See all news. What if I do that? Job cuts in June. This is not all eBay news. Damn it. That's a shame, because you see, this is full stories in Seeking Alpha, and if it would lay out all of eBay's news like this, I could then turn around and have Gemini take a look at it and summarize everything for me. That would be amazing. It's got to be able to see it. It can't be collapsed. So as it stands now, when I'm on News and Seeking Alpha, I show full stories, and it can now summarize everything it sees, which is great. All right, let's see what. Based on Stockopedia, here's an analysis. Cash flow, cash, 4.7, 49% decline. Cash drawdown, 3.1 billion reduction. Accelerated share buybacks. Debt management, net debt increase of 1.9. I told you there's an increase. Working capital volatility. Net fixed assets, shareholder equity, liquidity squeeze. Working capital dropped 85% from the 2022 highs. Cash burn. Cash, I don't like that. See, all these are nasty. Well, that's why he listed them under critical concerns. Investment trends. All right. So what's the Real deal. So I'm saying that it looks to me like the good news is kind of baked in, which is what Bodie said in his first pass. He said, you know, they already had a big bump off of that news, so it's not like it's new to anybody. And there's a bunch of maybes here, so I don't think I'd be jumping on this. No, not the tariffs. Hmm. Oh. I need more water. All right. eBay's debt is not rising, it's actually declining. Okay, so he likes it. Debt's declining. eBay's paid down $2 billion in long-term debt, strong cash position, 4.8 cash, healthy interest coverage, no liquidity crisis. Why did net debt tick up? The buybacks and dividends, which I'm not necessarily in favor of, it's a lot of money, still has $2.75 billion under its buyback authorization. Strategic investments, eBay is investing in AI. That freaking AI, huh? Cash and investments. See, then I'd want to find out what they think they're doing with AI, but generally eBay is the kind of business that could benefit from it. Cash and investments have come down from the peak, but this is a function of capital returns and investment, not operational stress. Are they investing in the future? They're explicit, they prioritize long-term health. eBay's debt is falling, not rising. Balance sheet solid, no signs of distress. Recent uptick in net tick. Okay, so okay, good. All right. Bodie's happy with it. I feel happy with it. I feel better about it from that explanation. But I still would want to read up a bit on it and see what the general consensus is. And what is the general consensus here? EBAY. The thing about seeking alpha is you have to be aware of which authors are idiots. Not that any of them are idiots. I don't want to burn any bridges, but you know, let's say you have to be aware of the quality of the different writers and who knows what they're talking about, more so than some others, to be as diplomatic as I possibly can be. Anyway, so U.S. reduces China de minimis tariff. SEC filing. See, we could read the quarterly report. We could look at their growth strategy. So on. Oh, here you go. Oh, here's a great use of whatever the hell it's called, Gemini. Too long, didn't read. eBay had a strong start to 2025 with gross sales volume over 4 consecutive quarters. The company's strategy focused on using AI, improving key areas for trading cards and fashion while they face trading cards. Really? While they face risks from challenging global economy and trade tariffs, especially in Europe, eBay's management is confident in their plan for continued growth. All right, so that was a little too short. I could have asked for a bit of summary. All right. Please provide analysis. We're concerned about their deal with Meta. So again, right here on if you're in Google Chrome, it's right there anytime you want it. I think Bing does something similar. If you're in Microsoft Edge, it has something similar, but I don't really use that. I gave them another shot recently, and it's still like lame compared to the other AIs. So first quarter, eBay signs a stable growth, but gross merchandise. eBay is integrating AI to improve user experience, particularly with the features like enhanced discovery, tools, fashion integration. The company is putting a strong emphasis on high-value categories, including trading cards and fashion, where it's seeing growth. eBay is using speed pack shipping to help sellers navigate complexities. See, that's interesting. They can apply the AI to the shipping to optimize things for their. It's a service to the shippers, to the sellers. It's fantastic. 10% increase in non-GAAP earnings per share, returning. Well, that's because they're buying back all the shares. It's not that impressive. Analysts of risks and concerns, macro headwinds, trade and tariff stuff, and competitive pressure, same thing everybody has. Contrary to being concerned, the partnership with Meta is a strategic move to expand, increase visibility, seamless integration, no opt-in required. eBay automatically includes listing based on factors like account standing, shopping trends, and listing quality. And again, this is where AI helps, right? It fits the criteria. The partnership's direct response to pressure on Meta. Okay, great. Very, very nice. I'd say on the whole, that's a good catch. Good. It's probably a good thing to invest in eBay. Cody says, we'd love you to talk about the opportunity to invest in your AI that someone talked about yesterday in chat. Can you please give us some more information for this and how exactly to invest? All right, well, this is serious investing. This isn't like, a few bucks. This is hundreds of thousands of dollars. We are taking the AIs that we have, like Bodhi and like Warren, that we've developed with Mad Jack. PSW Investments has the right to use and monetize them in the financial sector. Although to be honest, if we are financially able to, and we want to monetize something like the Hitchhiker's Guide to the Earth or Sherlock, we can do that too, because it's not like they have anything going on yet for that sort of thing. So, we could just sort of take that sector over if we have a viable plan to market it and do something with it. But anyway, the concept is we have developed extremely sophisticated financial modeling robots, as you can see, and we just need to be able to put them into sort of like apps and things like that so that we can sell them to consumers. So when I say, so watch this. So if I say to Bodhi, sorry, it's comment things in the way. So if I say to Bodhi, can you give us a good, bad, and ugly report on, let's say on eBay, since we've been discussing it, so you guys don't know what it looks like. So people love the format of this report, and we can, tighten it up a little bit and add some stuff. But look what he's doing. So he's going through this stuff. He's looking at the financials, getting the earnings. He already knows to do all this stuff. He's looking at their quarterly reports. He's bringing up these sources and going through them. Identifying challenges and risks. Oh, well, he did it too fast for me to read what he was doing. But this is a fantastic report that people love, and we can turn this into an app and have people pay us just like $10 a month. We got 1 million people paying us $10 a month to get this on every stock they have. Whenever they want to look at a stock, they can bring this up. And look at the footnote like these. They all come up as footnotes. Everything is linkable. There's no chance of I mean, he can make a mistake, but if he makes a mistake, you can see what he made. You can see what he did. So the good, the revenue, the gross merchandise volume. Look at this report. Non-GAAP, GAAP income, strong margins, healthy cash flow, shareholder return. So he's hitting all the points that we just discussed. Balance sheet growth. Wow, this is a good report. He likes them. There's a lot of stuff under good. Debt is manageable, cash position. I mean, this is not just a list. This is like a thought out execution coverage. Strategic execution, focus. He's got active buyers, 134 million users. That's why Facebook is going to really kick them up. Ad revenue is up 13%. The bad, sluggish top line growth. Revenue growth is tepid, only 1 to 2%. Q2 guidance is flat. Margin pressure, GAAP operating margin is down 23.8%. Oh, down to 23.8% from 24%. It's cost pressure, share buybacks and dividends. While positive for shareholders, these have contributed to lower cash balances and uptick in net debt, which is a thing I didn't like. Platform headwinds, private seller exodus, user complaints about fee charges and app glitches, which is always going to happen in transition, have led to a drop in small private seller activity. Regulatory issues, ongoing DOJ lawsuits, so we have to keep an eye on those things. And the ugly reputation, legal overhang, stalking scandal, that's a while ago. Jesus, that's still going on? Okay. The DOJ lawsuit we all know about too. The platform fatigue is frustrated. Again, I don't know if there's really better places to sell, but that's worth looking at. Competitive threats, micro. So and here's a summary table for what's good and bad. Here's the good, bad, ugly summary. Bottom line, eBay remains cash generating, shareholder friendly, blah, blah, blah. Now, you guys are all investors, right? Where do you get a report like this? This can be on your phone anytime you're considering a stock. All you have to do is punch in the name of the company or the symbol, or you can say to him, who makes, like, watch this. Who makes, is it Hoda sneakers, and if possible, give me a GBU report on them. You'll know what I mean. Hoka, they're Hokas. Look at this. I mean, so the company is now owned by Decker. There you go. So this is me talking to my mother. She wears these shoes, and I come away with the wrong spelling of it, and I can still say, who makes these Hoka things that all the old ladies are wearing? And he's going to tell me. And again, don't forget, I didn't modify him. I didn't change anything. I just asked him for another good, bad, ugly report. So if I had the app of the good, bad, ugly report, even though I don't know what the hell I'm doing, I could get this information. Who makes the sneakers? Made by these guys, blah, blah, blah. Hoka's headquarters. Where are Hoka sneakers made? They're made 50-60% in China, Vietnam. Notice he knows what you should care about. They do not manufacture shoes in the US. The global supply chain allows them to keep costs competitive. Rapid growth, popularity, innovative design, broad appeal, strong financial backing from Deckers, manufacturing risk, counterfeit concerns, competitive, blah, blah, blah. Look at all this freaking shit. Wow. Okay. What is HODA's impact to DEX bottom line? So look at all the, he's so fast. It's like, well, anyways, you see all the crap he's looking at. All right, there you go. Very nice. Oh, wow. That can't be right. Wow, 2.2 billion and Decker's total revenue is 4.9 billion? I find that hard to believe. Is that real? And isn't Deck buying Crocs? How are they getting all this money? 15 billion valuation, $5 billion in total sales. No shit. Wow. No, they're not buying Crocs. Who's Deck buying? They're buying somebody. They own Hoka, UGG, Teva, and Sanuk. Crocs owns Hey Dude. Is it Skechers? Why do I have in my head that Deck was buying somebody? $2.25. Ah, no, you are correct. There was a major but. Okay, Skechers is being acquired by 3G Capital. That's what I was thinking of. Damn. Deckers is not acquiring anything. Okay, Deckers, they're buying their own stock is what they're buying. And when was that? See, the links are great. That's like really does it. June 4th. So that acquisition is not closed yet. Why the confusion? Because Phil's getting senile. Wow, so we got to take a close look at Deckers after all this, because that's the play. Look how low they are. So they're going to buy $2 billion. That's 15% of their own stock. They're going to buy 15% of their own stock. That's going to drop this from 16.3 to minus 2.4, about 14. So that'll drop their PE to about 14. It'll really damage their cash position. But look at their net debt. They have a surplus of $1.8 billion. So they're taking their cash surplus and buying their own stock because they feel that's the best use of their own cash. And they're making $1 billion a year. So in other words, what their logic is, and very rarely do I endorse a buyback, but you know, they're saying it's like, dudes, at half our previous price, from the beginning of the frickin' year, what did they do that was wrong? Did they even miss earnings? This is where AI is great for me because it just saves me so much research time that I get to like go bit, and suddenly you can see a trading opportunity that I wouldn't have ended up researching before. And this is all like tangential stuff. But yeah, in January, they were 220. they fell off a cliff on the tariffs, and of course they fell off the cliff on the tariffs, but now they're ridiculously low, or maybe not. And then and again, this is what it is about the bot investing. So DEC seems to be down over tariff concerns. How? Please game out the potential impacts of tariff outcomes and let me know if this is still a good stock into January 2027. So Bodhi's my go-to assistant, and we wouldn't release him to just be used by anybody, but we create an app that utilizes a instance of Bodhi that we would create specifically to do like good, bad, and ugly reports and things like that. And like I said, if we can get 1 million people, you know, we advertise on Robinhood and things like that, and we put it out there, and if we can get 1 million people to pay $10 a month for an app, which is not much money, that's 10 million a month. That's a lot of money. So there's our business plan. Basically, it's very simple, and we can do multiple streams of these things. And not only that though, but I'm getting some of our bots like Warren are getting smart enough to be able to run his own website. So we could actually have an entire website that's like PhilStockWorld, but run entirely by the bots. Oh, no, that was my prior question. Okay. DECA's tariff impact analysis, current price 90. Oh, wait, he got the right current price. That's one big weakness he has. DEC 101. That's one thing I have problems with him about is that. Target horizon, blah, blah, blah. All right. So tariffs ease, probability 30% Biden, Biden and concessions. So two things wrong. Financial impact on DEC of $50 million cost mitigation, margin stabilized at 56 to 58%, stock price implication, still 160 to 180. I'm still a lot higher. Status quo, current 30%, China 10%, Vietnam falls persist. I don't see this as being a 50%. China 10% is not right. That's not going to be that low. Still keeps them in the market on the stocks. Tariffs escalate. There's a 20% chance of that happening, and that brings them down to where they are now. So if we're going to invest in these guys, it would be fairly conservatively. We'd probably try to make it an income-producing play, but they are kind of playable. It's a strong play, and it's only down because of the tariffs. And if the worst case tariffs don't do well, if the worst case tariffs don't play out, which Bodhi doesn't think they're going to play out, but I think there's more likely, then we'll see. Brand pricing leverage, supply chain diversification, financial resilience, international growth. Watch out for consumer demand, execution risk, and the regulatory overhang. Here's their EPS targets and price targets, which is the same thing as we saw before. So really, they're really down over tariff fears. The whole thing, it's an insane reaction because that's implying a massive, massive loss. And don't forget that even if there's a 50% tariff on the shoes, right? The shoes don't come in like $100 pair of Hoda sneakers. They don't come in at $100. They come in at like $30, and then they're sold to a retailer for $50. And what they're going to do is they're going to start having an intermediary retailer who belongs to Deckers, and that retailer is going to pick up the shoes at the port, and they're going to charge that retailer a low price. That's how you get around tariffs, right? You don't sell your shoes directly to Walmart. You sell your shoes to the Decker Distribution Corporation, and the not so obviously, but the Decker Distribution Corporation buys the shoes for effectively your cost instead of a markup, and then they do the markup internally in the U.S. and your company realizes the profits in the U.S. instead of recognizing them overseas. That's how you do it. It's not that complicated. So the impact on the tariff is less than you think, especially if a $100 shoe comes in, even if it came in for $35 at the port, right? And they say it's 50% markup, that markup is only $17, $18. You know, the tariff is only going to be $17 or $18. So the $100 shoe is $117. It's a 17% increase in the cost of the shoe, not a 50% increase in the cost of the shoe, because it does in fact go from Decker. It goes from Decker's manufacturer to the port to the probably directly to the distributor, and then the distributor does the markup for the rest. All right, but as you know, when you go into Foot Locker, it's like things are 30-40% off all the time. So it's like they obviously have the markups on that level to sustain these things. And so all they're going to be doing is paying that amount. It's generally, as a rule of thumb of the tariff, it's going to be no more than half of what it says it is the actual impact on the item. So there's a lot of alarmist stuff going on for these things. Ugh. All right, what else is going on, guys? Any more questions? Let's see. Cody says we should trade deck. Yeah, it looks good. It's certainly worth looking at because it's very cheap down here. And the thing is, again, let's go back to it without making a trade. Let's go take a look. So now with Deckers, they're not paying a big dividend. They're doing a buyback that's different. So we don't want to own, we don't want the shares of Deckers, but what we do want at 101, let's say we like this channel, we don't have to be too up there. We can play, first of all, this is 26.50, let's say, so 26.50. Now, what if I did the 90s? And 90s are 30. So if these are 26.50 and these are 30, it's worth spending $3.50 to have the better strike, right? And to have a $10 better strike, I'm going to spend $3.50. Of course I am. What would be the point of not doing that? So now these are, well, what do we say they are? 30? Well, they just jumped up. So if these are 30 and the 80s are 36, now it's $6 to go 10 down. So my optimal strike is now here at the 90s. So if I can get the 90s for $30, then yes. If they're not $30, because it just jumped to 33 on the ask, if it's not $30, then I'd revert back to these at 26.50. But let's say we do get these for 30 in the 90s, and then we sell the 120 calls, and those are 1850, 1860, whatever. So what did I just say? 30. So 30 minus 1860 is 1150. So that would cost me $11.50 on a $30 spread. The 90-120 spread would cost $11.50. That right there has $18.50 of upside potential at 120. And since I'm paying $11.50, I'm effectively paying $101.50. I'm paying no margin because I sold the margin. I sold the premium. I'm sorry, premium, not margin. I'm paying no premium because I sold the premium to another guy. So all the premium I bought down here, I'm turning around and selling it to this guy, and that means I'm netting in for $11.50 on the $30 spread. I don't care if this guy makes money. God bless him. I hope he makes a fortune because it means we're in the money. Doesn't matter to me what he does. Now, we can then say also, I don't mind being in Deckers for $80. So if I sell the $100 puts for $19, that's net $81. So if I sell 5 of those for $19,000, that's going to knock $9,500, 5 times 19, it's going to knock $9,500 off the cost of my bull call spread. So even if I buy 10 for $18,500, the $9,000 I collect on the other one is going to knock that in half, and now I'm in the $30,000 spread for. I'm sorry, I think it wasn't 18, it was 1150. So now I'm in the spread for a couple of bucks. So yeah, that is the kind of thing we like in a long-term portfolio. And being the case that it's so cheap, I can also leave a few uncovered, and then we can see about collecting some income off the short-term calls. So the September 110 calls, which is 10% higher than it is now, are $6. So if we sell some of those for $6, this thing turns into it's a money maker, and it's a great spread that's in the money, and we have a 200% upside potential, 300% upside potential on it. So yeah, I like it. I like it because I think it's already low enough that I'm not too worried about it going lower. And even if it does go lower, it's only because of tariffs. It's not because they have a bad business. And since they have cash in the bank and they make a tremendous amount of money, they make $1 billion a year. So even if they go down to even if they cut it close to the bone at zero and the stock plunges to $80 or even $60, I don't mind doubling down and having a bigger chunk of this thing, because eventually the tariff nonsense will either end, it'll get rescinded or drawn back or something like that, or it'll just end up being normalized into the prices. And that's why the Fed likes to say transitory. They say, yeah, it's going to be a price spike, but it's going to be transitory. It's not transitory in that it'll go away. It's transitory in that you'll get used to it, that you'll say, oh, well, that's what those cost now. It's only shocking for a little while. That's why inflation is weird, because you watch inflation data and inflation goes up and up and up. And clearly, well, I mean, you know, when I was a kid, I had a paper route. And on the highway where I was delivering papers, there was a big giant sign for Volkswagen Beetles. And it was I guess it must have been like 73. I'm gonna say it was 73, because yeah, it's about 10 years old. So it was a 73 Beetle, $1,999, brand new. Okay, then that was the sign on the road, was to say come by it at some place. I don't remember the place, but the reason I had the paper route was because that was my goal. I took half my money every week, which was like, well, originally when I started, it was about 10 or 15 bucks I would make on the paper. I mean, I'm sorry, I'd make 30 bucks on the paper route. I'd take about 10 or $15 every week and put it away. And I'm like, okay, well, by the time I'm 15 years old, that's when you got your permit. By the time I'm 15 years old, I'm going to be able to buy that car. That was my plan. That was my main motivation for having a paper route. What happened is eventually the other kid, the kid next to me, quit or whatever happened with the paper route. There's a lot of turnover on paper routes. So the kid who had the route next to me, he quit or whatever. And the guy who ran it, because my paper route was always like perfect, and the guy who ran it gave me his paper route for a while, and then I was keeping both of them up perfectly, and he was like, oh, well, you just keep doing it then. And so suddenly I'm making like $40, $50 a week as a paper boy when I'm like, I was 11 years old. And I was just raking it in. I was like the richest kid in the neighborhood. This is $1973. So, I mean, I was like on the way to buying that car like immediately. I mean, that was a week, 50 bucks. It was, yeah, it was 2000. That was enough money to buy the car in a year. I was just raking in cash. So I bought a lot of comics. That's what I did with my money. I bought a lot of comics. And other fun stuff. I literally had all the money in the world. I mean, my parents didn't have to give me any money. I could do anything I wanted. My friends want to go to a movie. If we went out, I'd be like, hey, I got money. Don't worry about it. All I had to do is get up at 5 in the morning and deliver 100 papers. And then go to school. That was the only, and I'm a morning person, so it never bothered me. But anyway, so what was the point? Inflation, yes. So now here we are, I can't even, here we are, I can't do the math, but whatever year it is, 50 years later. So here we are 50 years later, and a new Volkswagen Beetle is what, like $30,000. It was 2,000, now it's 30,000. That's 15 times more than it was when I was a paperboy. And that's inflation. But like I said, you get used to it. I mean, first of all, in California, the minimum wage is 20 bucks going up to 30 bucks an hour. That wouldn't apply to a paperboy, I don't think, but whatever, because you're an independent businessman when you're a paperboy. So your minimum wage is going up, but even if it's 20 bucks and you work 40 hours a week, that's 800 bucks a week. That's 40,000 a year minimum wage. Minimum wage was like $1. I know what it was. It was $1.15 when I was a kid. So minimum wage was $1.15, and now it's 20 bucks. So minimum wage has gone up as much as a Volkswagen. So that's what I mean by getting used to it. It's not like the inflation doesn't retreat, but eventually things catch up. But unfortunately, there is a transitionary period, which we're in right now, in which inflation comes up and wages go up, and inflation goes up and wages go up, and it's messy until we hit the equilibrium point. And that's what the Fed stuff is all about. And I don't know what happened in Congress today with Powell, but he did speak to Congress. Spoke to the Senate today. You know, yesterday, see, it's a weird thing because it's almost like it was engineered for us not to know what he said, because oh, that's briefing.com, Bloomberg. Powell won't say if he'll stay on as Fed chair if his term ends. There's no way he's staying on. Who said that? That's insane. Russia is open to output hike. Oh, that's bad for oil. Oh dear. Dun, 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 dun. Did that send oil prices lower? Nope, still flat. Interesting. So Russia's gonna, oh well, Russia's kind of sanctioned for us anyway. Petrobackers with lawyers, Colombian World CEO, Federal Reserve releases plans to relax key bank rates. That's bad. Nike, Nike's still making stupidly expensive things. Mercedes, an electric hypercar. Pom. Oh well. Anyway, so we don't know what Powell says. He got knocked off the pages. Trump made this big speech where he was just ranting and raving at the summit. So he says U.S.-Iran will talk next week. Mideast war is over. He wants a Nobel Prize so badly. It's like he's just dying. He was sitting there. That's what he's mostly talking about this morning. He's constantly, I accomplished this, and I made this peace, and I saved that, and the world is safe, and we were all going to be nuked, and here it is. We're all good. So who knows? He did convince Europe to spend more money on NATO, though. That's pretty crazy. So you got to hand it to him. He did that. Oh, that wasn't true. Shell said there was a rumor that Shell was buying BP, but I thought that was a little weird because that's a lot of money. I'm not even sure Shell is bigger than BP. Powell says the end of the Fed's paying banks don't save money, blah, blah, blah. Okay. So that's where we are. Lots of weird stuff going on and a lot of things happening in the market. And today, probably answer that question. Cody, yeah, talk to us in chat or contact Maddie at PhilStockWorld. And we can talk to you about that. So anybody's interested in investing in our AI program, we haven't formalized it yet, but we will shortly. And I'm telling you, I mean, they're throwing hundreds of millions of dollars at any kind of AI company, and we are going to create a little AI company to capitalize on what we've got here, because we have some really exciting stuff, and we've made some major advances that we're going to be able to market. And that's what we're going to be working on for the next couple of months, actually. So thank you, everybody. I appreciate it. Brendan asked about UNH. This will be our last thing we talk about. UNH is a little bit scary still. We've been looking at them several times. We did pick them up last quarter, but last quarter we were so massively ahead that we were happy to take gambles in the LTP. And And now we're not. We have a new LTP. This is an expensive stock. We probably won't be jumping in and doing this. I do think that the problem with that, with United Health, it's technically a value unless it's a big unless they lose their Medicare deal, Medicaid, whatever. If they are ruled to have done have done fraudulent things with the government with their reimbursements, if the DOJ comes down hard on them, and you never know with the Trump administration, it would be crazy. A quarter of the people in the country are using UNH. If they cut UNH, or if they take away their ability to do business with the government, the company could be in chaos. And I'm not sure how easily they would recover from it, or that Americans on healthcare would recover from it. It'd be a complete disaster, and it would jack up the rates for everybody else, because everybody would have to run to other companies and stress out their resources. So it would be stupid for the DOJ to do something that destabilizes UNH, as the country counts on them for healthcare. But on the other hand, you never know what Trump's going to do. If the people at UNH piss him off, if he doesn't like the guy, he can turn it into a big thing. So there's that risk possibility that's kind of unacceptable. We can't afford to lose that kind of money. We can't afford a $300 stock that could drop 50% in any of our portfolios. We're just not that big. When we had $5 million in our portfolios, that was great, but we cashed out those portfolios, and now we've got $1 million. And with $1 million, this is not a stock that becomes very attractive to us. So for that reason, it's not worth the risk. Okay, when last month, when they dropped down and this happened to them, it was worth the risk, because we had, we were up hundreds of, 200, 300, 400% in our portfolios. Who cares if we gamble $50,000 on UNH when it has a huge upside? It's not like that now, though. Now the whole portfolio is $500,000, and I'm not going to, the whole long-term portfolio is restarted with $500,000. I'm not going to mess around with a stock that could have a catastrophic failure. That's the problem. As a gamble, if you want to take a flyer on it, I don't object to it, but it's not right for the portfolios that we have now. All right. Thank you, folks. Very much appreciated. And we will, whoops. Will we do it again next week? Yeah, because the holiday's not until, we only have the actual 4th off, right? Nobody's going to be Thursday. Everyone's going to leave early. I'm going to leave early. Screw you guys. But Thursday, we're all going to take a half a day. And then we've got Friday. And then Monday, we're going to take a half a day, because who the hell is going to show up for that? So big long weekend next weekend. And but next week on the 2nd is fine for me. So we shall do it again next week. I'll see you guys then.